Hit the notification bell for daily content. Let's go.
Title of the presentation that I hope shows up on the slide. There it is. Thank you. So thank you for inviting me and to a conference on structural changes that Maury and Pierre put together, and how financial regulations might usefully help to steer developments. So I'm going to speak on money and payments, navigating change in the U.S. And I guess as you know, with the title, a few natural questions you might be asking yourself is like, what is new? Why would modernizing the financial plumbing of the financial system be interesting? And would changes really be structural? So I'm speaking from the U.S. Treasury, but these views reflect my views, and I'm also have been working on a paper with a former colleague that this is being, some of the material in here is from there. So let me start with, so what motivates this discussion? Let me give you an overview of where I'll go. What motivates this discussion are two developments. First, consumer demand for electronic payments have been increasing for some time, and they really surged during the pandemic when we were all home and not interacting with others. Second, the advances in technology, just basic computing power as well as cryptography, are fostering innovations in payments to make them more efficient. So these two developments have created opportunities to upgrade the plumbing of, with two possible systems. One is fast payment systems, and the second is tokenization of money. And if we combine these two technological systems with updating regulations in the United States, I think we can foster faster adoption, ensure stable money, and modernize the U.S. money and payment system. This new system would create substantial, in my view, economic benefits in addition to increasing efficiency of payments. And I'll talk about those benefits. And finally, I would just say there is a reason to engage purposefully in modernizing payments right now because many other countries also are embracing new payment technologies to further their own economic and geopolitical objectives. So with that, that's the overview. So if I run out of time, you'll get a sense of where I'm going. So it turns to the next slide. So just a little background, just for background for the US. First, the share of cash payments has been declining. In the United States, between 2017 and 22, the share of cash payments fell from 31% to 18%. The share of credit and debit card payments rose from 49 to 60. Not on the slide, the share of people who made at least one mobile payment in a month rose from about 25% in 2017 to 68% in 2021 and stayed up near there in 22. The U.S. also spends substantially more on payment services per transaction than many other countries. This owes in part because we seem to like credit cards, but even debit cards are very expensive in the U.S. Debit and interchange fees are about 0.8% of a transaction in the U.S., and they're about 0.2 or 0.3 in Canada and Europe. So payment fees and settlement can take days in the U.S. still. And then, as you know, cross-border payments are even more expensive. So an important cause of inefficiency in the current payment system is that a non-cash payment typically involves a gap in time between when you initiate a payment and the transfer of funds. And this means that payments don't settle in real time, and in that interval, they create counterparty risks and liquidity costs for the payees, the receivers, because it takes time to receive a payment. I'm going to use Karsten's speech he gave at the end of last year to help frame some of the discussion here. But he attributes the costs of payments to the fact that money resides in like different data silos. We call them banks, but they're different data silos. And, payments are expensive and they're error prone and they're inaccessible because of these frictions in transferring value across the banks, across these silos. So if you think of payments being inefficient for this reason, it suggests there's two ways to improve the status quo. The first is just to make more efficient the mechanisms for transferring value across the data silos. And that's what retail fast payment systems do. A second option is to move from the current system of silos to a new system in which data resides on a ledger, a common ledger. And that is what tokenized money is. So those are two different ways to think about upgrading the system. So I want to just spend a minute more to talk about what these two options are, both I think which are possible. Fast payments is a very near-term possible option. Tokenization is clearly more ambitious, but we are on track. So fast payment systems, what they do is allow a payer to initiate and then make funds available to the payee in real time or near real time, and pretty much 24/7, 365, round the clock. So consumers how you get this is consumers get access to fast payments through banks that can transfer value in real time among themselves. In the US, there's two interbank settlement systems that enable banks to conduct these kinds of value transfers. First, there's the clearinghouse RTP network, launched in 2017, but more recently, there's the Federal Reserve's FedNow service, which was launched in July 2023. It started with 35 institutions. It now has, as of February, 470 institutions. There's clearly an upward trend, but it's limited. And there's a couple reasons it could be limited. One, it takes some time to gain network effects. Two, there may be limited incentives on the parts of the intermediaries to make fast payments available to customers. They could lose out on some of their fees. Or it could just be there's limited consumer demand for fast payment systems, given all the other available payment options. But I would point out that Zelle, which you probably all know about, is a fairly new product, and the uptake and the speed at which it has been rising in the US, starting just like 3 years ago, now has about 1,800 participating institutions, suggests that we could get some scale up, and once it starts, network effects might cause it to scale up quickly. I would just point out FSB in 2024, and their just recent report reports that actually more than 100 jurisdictions have now put in place fast payment systems. And many of these jurisdictions are establishing interlinkages with one another, but countries like Brazil, India, Thailand have shown that these payment systems, if you put in the right infrastructure, can grow very, very rapidly. Whoops, let me go back. Tokenization is a little more abstract. Probably you have less, practical interaction with it unless you use stable coins for payments, which many people have not yet done. But it could include tokenized deposits by banks, what we would call well-regulated stable coins issued by non-banks, and some digital assets asset by the central bank. Ownership of this tokenized money would be on a shared ledger, which is then accessible to all the participants. And they can transfer peer-to-peer on this shared ledger, and it's done in one single all or nothing step. And so it's less error prone and can be faster, and it's definitely instant. So this means payments are fast, again, less prone to errors because the balance sheets no longer reside in separate databases. As I mentioned, the current use in the US is quite limited. Stable coins are usually based only to trade crypto, not yet used for payments, although there is a non-bank payment provider that is now issuing a stablecoin to try to use for merchants. But there are very important initiatives being led by like the BIS Innovation Hub to explore tokenization for cross-border payments, which includes central banks and private firms to explore. All right, so that's the background. So I wanted to just use most of my time, or the rest of my time, to talk about some of the potential benefits from what this new technology with a upgraded regulatory system could generate. And it's more than just making the payment system more efficient. And that's really what I want to talk about. And that's what in some ways makes it interesting and perhaps structural. And I just, as a little aside, going around this week, as an economist, we're being told that efficiency is not be all end all. And I'd like to say that like we can have efficiency and we can have other things. It's not always a trade-off. So in this case, I think we're going to get more efficient payments, but I think we also get some other benefits. And so this is where I want to go. One is gains. I call it gains from trade opportunities. And again, I'm using Karsten's framework. He discusses the costs of current money and payment system in terms of what are the hidden costs of a payment system. And that would be the potentially worthwhile transactions that don't occur because of the time gap or the inefficiencies. So these could be small payments that are priced out by high minimum fees. They could be very short-term loans that aren't feasible if you need time. Looking back, there's examples in history of how payments can generate real changes. And there's this nice example in a paper by Schnabel and Shin in 2014. And they describe like these significant increases in trade and commerce across distances after metal coins were replaced by paper ledgers, because then you could trade with strangers without being worried about having debased coins. And so like this increased trade created like day-to-day transactions created this relationship capital you had between your clients and your merchant banks, which then led to loans, like they call them acceptance loans. And then like that allows then, once you can do that, then you can let capital flow from where you need it to where you don't have it to where it is. So that's the kind of thing. Maybe in the modern context, I'm not saying this is quite as transformational, but you know, taxi drivers that use Square, if you pay them, there's a record. And now Square offers small business loans to taxi drivers based on their record of rides. And so it's like creating this new stuff just from the information available from these kinds of systems. So I do think there's potential, mostly maybe qualitative changes and certainly things we can't anticipate. And I think just providing that is useful, could be a great benefit. Second, advances in financial equity. In the US, faster payments could definitely reduce the incurrence of fees for like bounced checks or overdrafts, which in this country are more likely to be incurred by lower income households. Households who live paycheck to paycheck, it could help them avoid late fees on bills. You know, you just pay and it's met. It doesn't take a couple days to settle. There is some research on the adoption of fast payment systems in India and in Kenya that shows some income gains and less variation in household income from faster payments, as well as some higher small business creation. It's limited research because this is new adoption, but I think there's some potential. A third benefit is supporting the U.S. global financial leadership role. Upgrading the payment rails and establishing interlinkages with other countries with similar systems either bilateral or multilateral linkages, could support the use of the dollar. And this would certainly help support the dollar's international role, its use of national and security tools, and make cross-border payments more efficient. And as I mentioned earlier, aiming for this benefit I think is important because many countries are currently engaged in establishing interlinkages among their fast payment systems and are experimenting with tokenization, and the U.S. should be part of that discussion. And then the fourth benefit is just greater operational resilience for our payment system. Alternative systems could definitely improve their resilience if they wouldn't be disrupted at the same time other payment systems are. And if you were to adopt tokenization, you'd have an entirely different technology, so that would provide some resilience. Okay. This next table I'm not going to go through. It just details each of the benefits under each of the two alternatives. I just want to make maybe 2 points here. First, retail payment systems, the benefits are like the rows. You can see that retail benefit systems pretty much achieve all the benefits. Like you could probably get all the benefits you'll get from faster payments with retail payment systems, retail fast payment systems. And it's near term. It's possible we could get there in the near term, and there are benefits over the status quo. Tokenization gets you all that, but there are some additional incremental benefits. But it's clearly more ambitious, and there's more challenges and some risks. But you really might get something greater. So the gains from trade from tokenization could be substantial because you're going to have these novel capabilities of being able to program your ledgers and smart contracts and all that. And it could definitely be true if tokenization were to extend beyond payments to like tokenized securities. Securities have the same issue as money and regular payments. Securities are on one ledger and cash is on another, and they always have to reconcile. And you hear about securities fails all the time. That's because it doesn't always settle. So in this case, so I think there are some additional benefits, but as I said, there are some costs too. Okay, and this slide just says there are some costs, and just to round out the picture, there are some with tokenization, illicit finance. It is new operational. That raises some risks. You know, how much do you want to put in? There's potential financial stability risks. Smart contracts could generate outcomes that we haven't anticipated, so you want to think about that. But those are areas to consider when you're going in. I just make just one point on this slide. Part of the tokenization, so in the US, I think you also need to update the regulations for non-banks. Advances in technology on their own aren't going to ensure that we get these benefits. Non-bank payment service providers are regulated at the state level. Many of these frameworks were introduced in the 1930s for wire services like Western Union. So our current payment firms are quite different. The firms are growing, they increase competition, they can create efficiencies from innovation because they specialize. They just do payments, they don't do everything. But they can also introduce risk because they're creating money that is from non-banks, not banks. So there's some risk in the way they transfer value across account holders. So I would argue that as part of these advances in technology that I believe we should be trying to adopt, you also want to update the framework to address the risks, but also perhaps to encourage faster adoption. So just for those who are, we spend a bit of time on stablecoin legislation, which includes requirements regarding the assets to back the stablecoin, as well as high standards for operational risk and illicit finance. And these would sort of, they capture the elements of what an important, like new payment regulatory framework should cover. Okay, so then I'll just conclude, because I'm probably over my time. as I said, adoption and research and development of new payment technologies is accelerating. It's ongoing and it's accelerating. I believe the U.S. should be prioritizing modernization with these new technologies and updating regulation. Potential gains are significant, and the risks of not doing so are rising. And just to reemphasize, a reason for current prioritization is as other countries are investing resources, the U.S. should also engage to help develop global standards that are consistent with democratic values and privacy, and to be part of the development initiatives that support the use of the dollar and the use of its economic and national security tools. So with that, thank you.
Thanks so much.
Thank you for your time.
Thanks so much, Naomi.
Not to be a national security system. The role of the payment system would be to support the role of the U.S. dollar by having it maintain its technological status aligned with the rest of the world. As I mentioned, about 100 countries now have fast payment systems. There are many countries, they're looking at tokenization. Many are looking at CBDC, which is one form of tokenization. The U.S. needs to be engaged in those discussions. It's not a tool. The payment system is not a tool. It's a tool for national security. It's a tool just to support the continued use of the dollar, which has many other advantages for the United States other than national security. As you know, we benefit from the role of the dollar in the global financial system its use generates many, many benefits for the U.S. And I think that it's important then for the U.S. to sort of keep up to date with the technology of the rest of the world. I don't know if does that answer your question?
Look, people can see inside payment systems, and you saw that with SWIFT. And that was a crucial moment. I was in the room when the central bank governors got the message from the politicians that was what wanted to happen, what they wanted to happen. And the politicians thought that this was an easy win. And some of the central bankers at least thought this would be a Pandora's box. But that doesn't mean it shouldn't happen. That means for all of these things, there's a threshold. And the judgment about where the threshold is should be taken at political level. And I wanted to say that because I think that the US is in an incredibly difficult position with all of this central bank digital currency stuff, precisely because the Federal Reserve is the most important central bank in the world. It has tended to follow rather than lead in innovation. Certainly during my 33 years in central banking, and I think since. And when it has tried to lead, as it did with the review of its monetary regime, it has been abysmally poor at doing that, which actually I don't think is at all surprising, because unless you are in the habit of innovating, you don't learn to kind of have checks around it. And the changes to the monetary regime can be corrected. The costs of being too slow in this central bank digital currency thing are high, but the costs of you blasting ahead in front of others, I think, would be almost reckless. Mm-hmm. And I think actually you've struck a pretty good balance with that, and I think Jay's comments on it have been kind of measured. I think the whole of the Western world was slow to recognize that Beijing will have far fewer constraints on what is an acceptable digital currency world than in the liberal democracies. And I actually think the central bankers at the BIS spent far too time being dazzled by technology rather than thinking about the great architectural issues that feed into politics. But that said, I think you've caught up with that now, and I think you're striking a balance. And I wouldn't much tell people what you, the United States, are going to do, however much people shout at you to do so. Because after all, we all live under your security umbrella, and it's important for us to remember that.
All right, that was interesting. Patrick, do you want to react to this?
Yeah, it's not really my area.
Cash is, so there's no question that some of the crypto is being used for illicit finance. Cash is very anonymous. Cash is by far still, crypto is growing. Illicit finance has generally been regulated at sort of by the institution that issues the money or the currency, and not for every transaction that happens. It's not monitored at the transaction level. But I have noticed, and I'm not a deep expert on tokenization and the technology, Tobias probably knows quite a bit more about this than I do, but for enforcement actions, they almost always seem to be able to backtrack who was behind the trades. And it is on a blockchain, it is forever there. It is anonymous at the time, but it is trackable, it seems. So cash is not. Cash is pretty hard to track down. So I just want to kind of keep that in mind. But
Good message to give.
yeah.
Yeah, so we are unfortunately running up against the time limit. So thanks so much for the three panelists and fascinating discussion.